Your reaction, ma'am.
Yeah, I think surely the numbers are stronger than what we have been looking for. So if you look back to the trend of the economy was actually weakened quite a lot in the third quarter. In our estimate, third quarter GDP was contracting actually on a 3.3% pace on a quarter-on-quarter seasonally adjusted basis. So we have been looking for the growth momentum to recover into the fourth quarter moderately by about 4% on a quarter-on-quarter SAR basis. If you look back, actually the October data already came in somewhat better than market expected. And so on top of that, with this PMI reading, it does seem to suggest that in the near term, the recovery is coming in on shape.
On shape, how's that set up for next year? You're expecting that they're not going to be able to hit those growth targets.
Yeah, for next year, we are actually still quite cautious in terms of the growth picture. If you look at our growth number, for this year, we are looking for 7.8% for the full year, partly helped by the low base effect. But for next year, we are looking for about 4.7 on a year-on-year basis. And the way we look at the government's attention, it is quite likely that they will set their growth target at between 5.5 to 6, or if they are more tolerant of slower growth, then probably in the range of 5 to 6. But still, if we are right that growth comes in at 4.7, then there is still something further to do from the government side to support growth.
Right. And I guess if you put it this way, that it doesn't matter really what the growth is as long as the job market is stable. So what's the minimum growth rate that you think Beijing needs to hit for things to remain stable as far as employment is concerned?
In the near term, the official number actually does seem to suggest that labor market has been holding up pretty well. We have 4.9% on the survey unemployment rate, which is a very decent number, even if you look at the pre-pandemic period. However, there is the issue that the official number might not have caught the full picture of the labor market. And what is concerning is that if you look at some of the soft pockets in the economy, in terms of the housing market, and particularly in terms of some of the new growth areas, considering the tightening measures the government has come in on the e-commerce sector, on the private education sector, we might see pockets of softness in the labor market, which may not be fully reflected in the official data. So in that sense, there is still some stress on, for instance, household income, consumption, service sector growth for next year.
There's talk of, with this new virus strain, that it seems China is almost vindicated that they are going to stick with this zero COVID policy. How sustainable are these numbers then, if now that we have this new threat?
Yeah, indeed. We have been looking for the labor market and also consumption and services to gradually recover, indeed, from at the beginning of this year. But we have been somewhat disrupted by the various local virus outbreaks that come and go. And so in that sense, with this virus coming in, new variant coming in on the external side, it does add some further uncertainty to the domestic economy. But I would say still, in the bigger picture, the way we look at the growth for next year, a very important factor is the policy regime change, which basically means that in the past, the government was wholeheartedly focusing on the growth, pace of growth. But now, with the economy's potential growth slowing down, population aging, there is growing attention on other targets, such as financial stability, common prosperity, decarbonization, housing market stability, and so on. So with the multiple target in mind, it becomes harder to so heartily focusing on the growth of pace of growth as we had been experiencing in past cycles. That adds to the policy complication.
Yeah, and with all those things, I mean, 4.5% might even sound optimistic, because all of those things, including consumption, by the way, which you would hope then picks up the slack, is also on the weaker side of things.
Yeah, exactly. So we do therefore see some uncertainty in terms of the macro policy response in this regard. As in, if we are right that growth comes in at 4.7%, which is most likely below what the government's lower range of target growth is, then that would add pressure on the government to come in with some more policy support. So for instance, at this moment in time on monetary policy, our baseline do not factor in any further RRR cut or interest rate cut. But with the downside pressure on growth, if that were to linger on, it is not impossible that the government might be forced to come in with a little bit more of growth support measures than what we are looking for at this moment in time.
Strong exports, that's really what's been supporting the renminbi and the strength that we've seen of late, even against a stronger dollar. Is that likely to stay the case?
Yeah, I think the renminbi has been one of the strong surprise for this year, even in the background of a strong dollar. And that has been supported by strong exports, as well as the ongoing strong FDI and the portfolio inflow into China. The way we see it is that next year, the dollar is still going to be quite well supported, but the renminbi's fundamentals would remain somewhat intact, at least in the first half of the year, with exports still in solid shape and with ongoing FDI and portfolio inflow in the first half of the year. So in the first half of next year, we see renminbi dollar at around the current range, 6.35, but then that could be followed by a little bit of softness into second half as the rest of the world opens up, and then China's export share of the world might begin to trend reverse a little bit. So in that sense, our year-end 2022 forecast for renminbi dollar is about 6.55.